Hello everyone, welcome back to your channel. April 2026, LNG Canada loads 1 million metric tons of liquefied natural gas onto tankers bound for Asia. 1 month, one record, a figure that rewrites 40 years of Canadian energy history. Trans Mountain transports nearly 600,000 barrels per day to the Pacific coast. Asian refineries pay prices tied to Brent, the full global market price. No discounts, no concessions, no excuses. That is exactly what it means. For 4 decades, American refineries purchased Canadian crude oil at a structural discount, sometimes $20 below market value, sometimes $40, every single day. Not because Canadian oil was worth less, but because Canada had nowhere else to send it. That limitation is ending now, not because of a political speech, not because of a trade negotiation, but because of steel in the ground and ships on the water. I will show precisely how this changes the economic foundations and who loses when Canada finally gains options. Washington likes to call it market efficiency when the discount flows south, and strategic concern the moment Canada finds another buyer. I will begin with something most people were never taught. Canadian oil is not the same as American oil. Western Canada Select WCS is a heavy, thick, chemically complex crude extracted from Alberta's oil sands. It requires specialized refinery equipment. It cannot simply be swapped with light shale oil from Texas or North Dakota. The two products serve entirely different industrial systems. For decades, this technical reality locked Canadian producers into a single business relationship, one pipeline network, one direction south into the United States. When you only have one buyer, that buyer sets the price. This is not a conspiracy, it is not negligence, it is the simple arithmetic of market structure. Economists call it monopsony, a market with one dominant buyer. And for 40 years, the American refining system operated exactly that way. The result was the WCS discount, the gap between the price at which Canadian oil was actually traded and the value indicated by the global benchmark price. Over 2 decades, that gap averaged $17 per barrel. In 2010, it widened to $46 per barrel. $46 on every single barrel Canada sent south that year. Alberta's government did not accept that quietly. Premier Rachel Notley's administration imposed mandatory production cuts and legally forced oil companies to reduce output because the discount had become so extreme that producing more oil was actively destroying value. Canada was pumping crude that became worth less the moment it entered the pipeline system. That is the starting point. That is where this story begins. And now comes the infrastructure that changed everything. In May 2024, the Trans Mountain Expansion Pipeline entered commercial operation, a second pipeline running parallel to the original route from Edmonton, Alberta, to the Westridge Marine Terminal in Burnaby, British Columbia. Additional capacity of roughly 590,000 barrels per day to the Pacific coast. For the first time in the modern history of Canada's energy industry, a barrel of oil from Alberta had a genuine commercial alternative to the American market. At the same time, LNG Canada launched the first liquefied natural gas export facility in Canadian history. Canadian natural gas from Kitimat, British Columbia, began loading onto tankers destined for Asian markets. The April 2026 record of 1 million metric tons in a single month is not a forecast. It is a confirmed operational milestone. These are not political announcements, they are physical realities, and that is exactly what physical realities do to pricing systems. When Canadian oil had only one destination, the discount was structurally unavoidable and built into geography itself. The moment Trans Mountain gave producers a second option, the commercial logic shifted. Sellers with alternatives negotiate differently from sellers without alternatives. According to estimates from the Canadian Association of Petroleum Producers, the WCS discount against WTI narrowed significantly after the expansion. Those figures reflect their source. They come from an industry association and should be interpreted accordingly. Yet the direction of the trend matches what basic supply and demand theory would predict. Canada built an exit route, prices followed. That is the uncomfortable truth about infrastructure. Unlike a Trump press conference, it cannot be inflated through volume alone. But this is where the story becomes more complicated than any headline will admit. This is the part almost nobody is connecting right now. When Trans Mountain opened the Pacific, the narrative became simple. Canada wins, Asia buys, America pays more. A clean story, a satisfying arc, completely incomplete, because three different Asian countries are purchasing Canadian oil and gas, and they are buying it for three completely different reasons. Understanding those reasons is the difference between reading a headline and understanding a strategy. South Korean state energy companies, institutions like Korea Gas Corporation and SK Innovation do not make emotional decisions. They manage sovereign energy security. Korea imports nearly all of its fossil fuels. Diversifying away from Middle Eastern supplies that carry risk through the Strait of Hormuz is not a preference. It is a national security requirement. Canadian shipments arriving by Pacific tanker from a politically stable and legally predictable country satisfy every part of that requirement. Japan's major energy firms are making the same calculation with even greater urgency. Japan's post-Fukushima energy environment created a structural dependence on LNG. Long-term supply contracts with reliable, non-sanctioned producers are not optional. They are existential planning. Chinese refineries present a more complex picture. Access to American LNG has been constrained by geopolitical tensions. Middle Eastern supplies carry the risks associated with the Strait of Hormuz. Russian supplies remain available, but they bring their own political and logistical complications. Canadian energy arriving without sanctions risk, transparently priced and reliably delivered, fills a concrete gap in China's supply chain diversification strategy. Three buyers, three strategic calculations, one common thread. Canada is not selling a mere commodity. Canada is selling supply chain security in a world where security itself has become genuinely scarce. That is the upside of the Trans Mountain story. Here is the variable that complicates it: Venezuela. In early 2026, Washington and Caracas held preliminary discussions about returning Venezuelan oil supplies to American markets. The details of those talks remain fluid. As of May 12, 2026, no binding agreement had been confirmed through independent reporting, but the strategic significance is clear and cannot be ignored. Venezuelan crude is heavy and sulfur-rich, exactly the same technical profile as Western Canada Select. The same profile Gulf Coast refineries were built to process. If Venezuelan supplies return in significant volumes to American Gulf Coast refineries, those refineries will require less Canadian crude oil. The WCS discount, which had narrowed after the opening of Trans Mountain, could begin widening again. Analysts at CBC pointed to this risk in early 2026 and projected a potentially larger average discount compared to 2025 if Venezuelan supply dynamics shift significantly. That projection carries the limitations of its source, but the structural logic remains solid. Canada is not racing against a clock. Canada is racing against a pipeline from Caracas. Nothing says America first quite like the sudden rediscovery of foreign oil the moment Canadian bargaining power becomes inconvenient. And here lies the deeper issue that nobody in Ottawa says loudly enough. The negotiating leverage created by Trans Mountain is real, but it is not permanent. It does not sustain itself automatically. It exists precisely because Canada now has an additional route westward. If the next pipeline, the West Coast Oil Pipeline, fails to receive a final investment decision, that leverage stagnates. It does not grow. It does not strengthen further. The window is open, but windows do not stay open by themselves. Something has to hold them there. Let me translate that clearly. When energy ministers and trade officials talk about benchmark pricing mechanisms and netback value optimization, they use a language specifically designed to make people fall asleep. That is not accidental. Complexity is a political tool, so I will reduce it to what is actually happening. There are two major global oil benchmarks: West Texas Intermediate, WTI, and Brent crude. WTI reflects North American supply and demand dynamics. Brent reflects the global market. Historically, Brent trades higher than WTI. Not always, not by a fixed amount, but structurally, over time, Brent carries a premium. When Canada sells oil to Asia, it is priced against Brent. When Canada sells oil into the United States, it is priced against WTI, and then the WCS discount is deducted on top of that. Read that again slowly. Asian buyers pay the Brent price. American buyers pay the WTI price minus a discount. The same physical barrel of Canadian crude oil, two completely different commercial outcomes depending on which direction it moves. That is not a negotiating position. That is not a political argument. That is the mechanical reality of how oil markets price Canadian crude today. And that means every additional barrel Canada can redirect westward is a barrel removed from a structurally disadvantaged pricing system and inserted into a structurally advantageous one. That is what a pipeline truly does. It does not only move oil, it moves pricing power. A slogan can fill a campaign arena, but a pipeline fills a balance sheet. That difference usually survives contact with reality. Now I will show the three layers of political motivation driving and sometimes obstructing this transformation. Ottawa's calculation is theoretically clear and practically complicated. Higher realized prices for Canadian crude mean higher corporate revenues for energy producers. Higher corporate revenues mean greater federal corporate tax income. Greater tax income means more fiscal room for healthcare transfers, debt servicing, and every political priority the government must finance. The federal government has every financial incentive to reduce the WCS discount. But federal administrations also face environmental obligations, consultation duties with indigenous communities, and interprovincial political dynamics that make pipeline approvals among the most legally complex undertakings in Canadian public administration. The incentive and the mechanism move in opposite directions. Alberta's calculation is straightforward. The Heritage Fund, created to transform finite oil wealth into long-term financial stability for future Albertans, grows when energy revenues rise. The provincial budget responds structurally and sensitively to realized oil prices. Every dollar lost to discounts is a dollar not flowing into provincial revenues through royalties. Alberta has been the most consistent voice in favor of pipeline expansion, not because of ideology, but because of fiscal arithmetic. Now comes the layer rarely discussed. American refinery operators along the Gulf Coast have a direct financial interest in keeping the WCS discount wide. These facilities, some of the most technologically advanced industrial complexes in North America, were specifically configured to process heavy sulfur-rich crude oil. Their profit margins depend partly on the gap between what they pay for crude feedstock and what refined products earn on the market. A shrinking WCS discount directly compresses those margins. These operators are highly experienced players within Washington's political environment. They understand their interests perfectly well. I am not claiming there is a coordinated effort to obstruct Canadian pipeline development. I am saying that in every political environment, well-funded industries with clear financial interests actively participate in regulatory and legislative processes. That is legal, it is expected, and it is a variable in Canada's pipeline approval equation that should be openly acknowledged rather than ignored. In Washington, even silence can lobby effectively when enough money is sitting politely in the room. Now, I also want to state clearly what is confirmed and what is not. 3 pipeline projects exist in 3 completely different stages of reality. The Trans Mountain expansion is operational. Steel in the ground, oil in the pipes, tankers at Westridge. That is a confirmed fact. The Bridger pipeline reportedly has shipping commitments of roughly 400,000 barrels per day. Those commitments have been reported, but the underlying commercial documents had not been independently verified through publicly available regulatory filings at the time of this recording. It should be treated as credible, but not yet confirmed by the highest evidentiary standard. The West Coast Oil Pipeline, the project that would permanently close the WCS discount structurally if built and fully utilized, has no final investment decision. No confirmed private sector project sponsor has publicly committed the capital. It exists as a proposal, not as a project. The distance between those two things is measured in billions of dollars, years of regulatory procedures, and political will that has not yet been formally expressed. One confirmed, one credible but unverified, one still a concept. The entire strategic narrative surrounding Canada's growing bargaining power depends on which of these three is actually built, and right now, only one of them is real. That gap between the story being told and the infrastructure actually built on the ground, that is exactly where the political risk lives. That is precisely what must be understood before we examine what this means for your pension, your tax bill, and the price you pay at the gas station. This is where the discussion stops being only about pipelines and starts affecting you directly. Not abstractly, not theoretically, but concretely, within the financial systems that shape the lives of ordinary Canadians every single day. I will begin with the point that surprises most people the most. The Canada Pension Plan Investment Board, CPPIB, manages retirement assets on behalf of practically every working Canadian outside Quebec. It holds investments across several sectors, including Canadian energy. When Canadian energy companies receive higher prices for their crude, when the WCS discount narrows and revenues increase, the profitability of those companies improves. Improved profitability flows into federal and provincial corporate tax revenues. It also affects the valuation of equity holdings carried by institutional investors, such as the CPPIB. I want to be precise here because precision matters. This is not a direct mechanical connection. A shrinking WCS discount does not automatically increase your monthly CPP payment next January. The transmission chain is indirect, multi-layered, and subject to numerous intervening variables, including global equity markets, interest rates, and the specific portfolio decisions made by the CPPIB. What the data suggests, and I frame this as analysis rather than fact, is that a sustained improvement in revenues within Canada's energy sector creates a more favorable environment for the long-term compounding effect of assets that ultimately support Canadian retirement income. The direction of that relationship is logical. The scale of it remains genuinely uncertain. Now I turn specifically to Alberta. The Heritage Savings Trust Fund was created in 1976 to capture part of Alberta's non-renewable resource revenues and preserve that wealth for future generations. In the most literal sense, it is a sovereign wealth fund. Finite resources extracted from the ground and transformed into permanent financial capital. The growth of the fund responds sensitively to provincial energy royalties. Royalties respond directly to the price Alberta's producers actually receive for their crude oil, and that price is directly influenced by the WCS discount. A smaller discount means higher realized prices, which means higher royalties, which means a greater potential inflow into the Heritage Fund. Here is what analysts who closely monitor this say. The current size of the Heritage Fund reflects decades of pricing that did not capture the full global market value. Whether it could have been substantially larger under different infrastructure conditions is a counterfactual scenario, a hypothetical reconstruction of history, and I will not present a specific dollar figure as though it were an audited fact. What I will say is that the structural relationship between pipeline access, realized oil prices, and the accumulation within the Heritage Fund is real, direct, and consequential for every Albertan. Now comes the part that creates genuine frustration at kitchen tables across the country. Higher export prices for Canadian crude oil do not automatically reduce the price Canadians pay for gasoline. This is one of the most persistent and understandable sources of public confusion about the energy sector. Canada exports crude oil. Canada also imports refined products in certain regions. The domestic retail price of gasoline is determined by refinery margins, provincial and federal fuel taxes, local distribution costs, and global markets for refined products, not directly by the export price of WCS crude. That is why it is entirely possible, and structurally even likely, that Canadian producers benefit from higher realized export prices, while Canadian consumers simultaneously see no relief at the pump. Both things are true at the same time. That is not a contradiction. It reflects how vertically complex the energy supply chain actually is. The person filling their tank on a Tuesday morning in Calgary operates within a completely different pricing system than the tanker being loaded that same morning at the Westridge terminal. The same country, the same resource, an entirely different economic experience. This gap between those who capture the value of Canadian energy and those who bear the costs of Canadian energy is one of the most important and least discussed structural tensions in Canadian economic policy. It has no simple answer, but it deserves to be acknowledged because the pipeline story is real, the revenue gains are real, and the question of who actually experiences those gains in daily financial life is also real, and it still has not been answered. A politician can promise that prosperity will trickle down. Canadians standing at the gas pump usually discover that gravity was never consulted. I am not going to tell you how this ends, not because I lack an opinion, but because anyone claiming to know exactly how this resolves is selling a level of certainty that does not exist in this market, in this geopolitical environment, or in this regulatory landscape. What I can do is lay out the three development paths currently supported by the evidence and let you decide which of them Ottawa is actually prepared for. Scenario 1. The window remains open. The West Coast oil pipeline receives a final investment decision within the next 18 to 24 months. The Bridger pipeline enters full commercial operation on schedule. Asian supply relationships deepen into long-term contracts with Japanese and South Korean state energy companies. The WCS discount narrows further. Canadian producers move permanently closer to global benchmark pricing. In this scenario, Canada enters the next USMCA review cycle with demonstrable operational alternatives to the American market. That changes the geometry of negotiations in a way that is structural, not rhetorical. That is the kind of bargaining power that does not come from standing in front of flags and repeating the word deal until the microphones get tired. Scenario 2. The window narrows. Venezuelan heavy crude returns in significant quantities to American Gulf Coast refineries. The West Coast pipeline proposal remains trapped in environmental review or fails to attract a final private sector capital commitment. The WCS discount stabilizes narrower than its historical average, but it does not close. Canada retains partial bargaining power, but not transformative bargaining power. The energy story improves incrementally rather than becoming structurally different. Ottawa manages its relationship with Washington from a position of modest improvement, not genuine optionality. Scenario 3. The board is reset. Global demand for fossil fuels slows faster than current projections suggest. The premium Asian buyers are willing to pay for supply chain security shrinks as the energy transition creates alternative sourcing options. The strategic value of Canadian heavy crude for both American and Asian buyers declines over a medium-term horizon that arrives sooner than pipeline construction timelines anticipated. In this scenario, the infrastructure investment story becomes more complicated, and the window opened by Trans Mountain proves narrower in duration than in geography. Three scenarios, three completely different outcomes for Canadian energy revenues: heritage fund accumulation, pension fund performance, and federal fiscal capacity. Here is my question. Around which scenario is the current federal government actually building its policies? And do the infrastructure decisions being made or not made today reflect a genuine long-term strategic vision or merely short-term political management? The discount is shrinking. The window is open. What happens next is still being decided, and Canadians should fully understand what that means before the headlines tell them what they are supposed to think. I will see you in the next breakdown.